Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at some big retail stocks to consider buying before their upcoming earnings releases and possibly have them be a part of your long-term portfolio. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into a little bit of the market recap, before we get into the stocks, I want to quickly just touch on the three stocks we're going to talk about, and those are Walmart, Target, and TJX. So the stock market finally took a much-needed breather on Thursday after it had rallied for eight straight sessions. So the selling was due at some point, and the market used comments by Jay Powell as that profit-taking fuel. The Fed boss, though, pretty much stuck to his same line when he spoke to people from the International Monetary Fund on Thursday, and he said that the central bank remains committed to helping bring down inflation, and they're, quote, not confident that the current core policy rate is tight enough to drag down inflation. Thankfully, nothing really materially changed. Powell was never going to come out and say the job's done. He might never say that, since it actually makes his job a lot harder. Wall Street did slightly recalibrate its outlook for a possible 25 basis point hike in December, from about 10% on Wednesday to about 15% at the moment. Still, though, nothing much changed after Powell said that. So it was good to see the market then bounce back on Friday to hold that line at the 50-day moving average for both the S&P 500 and the NASDAQ. Once again, I'm recording this mid-morning on Friday, so the market was up solidly through then, and it was good to see buyers step back in. That said, some of the recent rebound was driven in part by short covering, so we'll need to see a little bit more actual conviction from the bulls for the rest of the year. So it'll be good to see if that happens. But the near-term catalyst could actually be some of the reports we're talking about today, and in insights we're getting on consumers and the health of the economy through the eyes of the consumers, which is a really big deal in a consumer-driven U.S. economy. And it is worth pointing out that the most recent Zacks data does showcase that the outlook overall for Q4 earnings has fallen rather quickly in the last couple of weeks. So we'll need to see how the rest of those results come in and if that's a more precipitous decline going forward. But overall, yeah, we were calling for about 5.5% earnings growth for the fourth quarter as recently as early October, and that's now down to just 1%. So the earnings outlook is fading rather quickly, so it'll be really important to see what we see from these consumer-driven retail stocks. Overall, though, we're still calling for solid growth going forward into next year, so we'll have to see what these companies like Walmart, which is the first company we're talking about, offer up in terms of guidance for the fourth quarter and possibly for 2024. So Walmart, which trades the ticker WMT, is set to report its Q3, and they're on their fiscal 2024 year already. Results on Thursday, November 16th. So Walmart stock is trading near all-time highs heading into that report, with shares up about 15% in the last year. The company's posted blowout results recently, and it continues to prove that its offerings are really vital at all times to consumers, and perhaps maybe most of all when people are a little bit worried about spending too much and looking for deals everywhere they can. So more people are flocking to Walmart. And so let's kind of dive into Walmart and see what's going on with the overall company and then what their other fundamentals are. So Walmart now offers delivery and pickup options like everyone else. They're trying to make the shopping experience as convenient as ever. They also have a broader push to compete against Amazon and Target that includes their own membership, which is that Walmart Plus, which is a direct competitor to Amazon in their Prime subscription. They're also focused on partnerships with other more like digital native brands. So they're trying to expand their reach while also just remaining that core Walmart one-stop shop that everyone knows and loves. They're also growing their own advertising segment as more shoppers start their searches on Walmart.com. And the company's really grown significantly recently. So its U.S. comps were up about 6.6% last year, up 13% on a 2-year stack. and its e-commerce segment has climbed by about 23% on a 2-year stack. And this is not even including that big, huge initial COVID boom. So overall, Walmart has roughly doubled its e-commerce business over the past 3 years. So that's including that big COVID boom. And it's also crucially continuing to innovate with new tech-focused and automation offerings. And this is everywhere from their stores to their warehouses, as they're really eyeing the future and trying to increase profitability as well. The company generated more revenue last year, so that was their fiscal 2023, than Amazon, than Apple, than ExxonMobil. So this just, once again, sometimes I think people can forget just how big Walmart is. They pulled in $611 billion last year. Amazon did $514 billion. Apple did less than 400, and ExxonMobil did 414. So Walmart is king at the moment and likely will be going forward. So Zacks estimates call for its same-store sales to climb about 4.9% this year, and then overall it's supposed to do about 5% higher revenue growth this year, and then another 4% higher next year to get all the way up to $665 billion on the top line. And its adjusted earnings are projected to climb about 2.5% this year, which is a good sign because that's continuing to see their earnings revisions trend in the right direction, and then climb another 9% higher next year. And it boasts a pretty impressive history of bottom line beats, including a 12% average beat in the trailing 4 quarters. And if we look ahead to 2025, which is next year for Walmart, its overall earnings outlook is just trending higher and higher and higher, which is a great sign. Overall, it now lands as Zacks ranked number 2 buy at the moment because of those positive earnings revisions. Then if we move on to its stock price performance, it's climbed about 58% over the last 5 years to fall just behind the S&P 500 and blow away Target, which is at just 23% climb. And if we look over the last year plus, Walmart has crushed its rival Target, and it's now near new highs as its core business is far more focused on essentials, and not all of those discretionary spending items that were really in vogue during that post-pandemic boom or that pandemic boom. Walmart actually hit new highs just recently in early November, and it still trades 10% below its average Zacks price target. And Walmart is trading 12% below its own 10-year highs at 23.8 times forward 12-month earnings. And on top of that, over 80% of the brokerage recommendations that Zacks has are strong buys or buys with no sell ratings, and its dividends yielding about 1.4% at the moment. So overall, Walmart is hardly a flashy stock. Obviously, that's a good thing to have, though, in your long-term portfolio. So if you're thinking about possibly adding Walmart as a kind of set it, buy it, and forget it kind of stock and see where it is in the next 10, 15 years, we've just proved with some data that Walmart is a giant and it's looking ahead. So certainly worth considering Walmart because it succeeds during good times and bad, and we could be headed into a economic slowdown based on some of the data we're seeing at the moment. So certainly worth considering Walmart as it heads into its report next week. And now we're going to move on to one of Walmart's big rivals that's actually had kind of really terrible results while Walmart's done well over the last year plus, and that is Target, which trades the ticker TGT. The company reports its Q3 2023 results on Wednesday, November 15th. So as I mentioned, Target's kind of on the complete opposite end of the spectrum to Walmart, having been hammered over the last several years. It's actually now trading about 60% below its all-time highs. So its valuation might start attracting longer-term investors and just its beaten down prices. If you're considering that some of the fundamentals we do talk about in terms of its business, maybe it's worth considering in the near-term future. So let's start with the bad, though. So Target stock was a pandemic and post-COVID superstar. It then, like many others, though, failed to adapt quickly enough to those rather quickly changing consumer shopping patterns that saw it suffer in a big way in 2022. It was stuck with a lot of inventory that it didn't need. Its sales were falling, and it dealt with those issues for a while in terms of inventory. It just had too much of the wrong stuff. Consumers had spent a year plus buying furniture and appliances, TVs, and big ticket items, and then they just weren't going to buy them forever because eventually you can't have too many TVs. So the inflationary crunch then was hitting shoppers, and Target found it harder than its rival Walmart because more of Target's business was made up from those discretionary items and less of the one-stop shopping essential items that Walmart is really famous for. Most recently in Q2 of 2023, its inventory was 17% lower than it was the year before, reflecting a 25% reduction in discretionary categories, is what the company said. That said, it was partially offset by inventory investments and support frequency categories and strategic investments for longer term opportunities. So just because they're dealing with some near-term setbacks, they're not just giving up on longer term expansion, which is a good thing, which we'll touch on a little bit. Still, though, the firm said, given its recent sales trends, that its full year sales and profit expectations were going to decline once again. And I'm looking at a chart of its earnings outlooks over the last 5 years, we can see just a fall off the cliff for 2022 and 2023 and 2024 and 2025 from those early 2022 levels. So just as soon as everyone was stopping buying TVs and all of that fun stuff and going back to their normal, just everyday habits, Target definitely suffered. So overall, we're calling for its 2023 sales to decline about 1.8%. and then bounce back by about 0.5% in 2025. So slow growth on the top line, actually a downturn this year. That said, though, on the bottom line, we're calling for adjusted earnings growth of 26% this year and then 17% growth next year. And if we look back, though, in terms of Target's recent results in terms of sales, it did about 3% growth last year, and then it did 13% growth in 2022, and then 20% growth in 2020. So just it was going to be hard to match those results, and as we can see, it's now facing these downturns and along with lots of changing shopping patterns. So now we'll take a little bit more of a long-term perspective on Target. So its e-commerce growth helped during the heart of the pandemic, and it will continue to help it succeed in the long run, as is the case with Walmart and Amazon and everyone else. So it's focused heavily on its in-store brands to succeed, and this is across everything from food to furniture to clothing. Its in-house brands are helping it stand out with certain clientele and demographics compared to the likes of Walmart and Costco. And these trends should be able to hold long-term if management remains vigilant. And then some are also a bit worried about the company possibly getting caught up in the wider culture war. So we'll see if that has any negative drag on the stock going forward. So overall, the stock's down about 60% from its peaks, but it's still up 24% in the last 5 years. And it's up 215% in the last 15 years, which still actually puts it ahead of Walmart, which is up about 195%. It's currently trading at a roughly 50% discount to its 10-year highs and actually near its lows over the last decade in terms of forward earnings. So it's trading at about 12.3 times forward earnings, which is actually not too far. It's actually below now its COVID lows and not too far below or above its 10-year lows, which it actually hit at the very end of 2018. So valuation-wise, it could start to be looking a little juicy. That said, though, Target's downward earnings revisions actually help it land its exact strike number 4 sell at the moment. So might not want to buy the stock heading into earnings, so kind of see maybe how the results come in. Overall, though, it's trading about 39% below its average Zacks price target, and 12 of the 30 brokerage recommendations we have are strong buys with 3 buys and the rest, so about half saying it holds. So overall, still relatively positive on the long-term outlook from Wall Street. The fall, though, actually has its dividend yielding about 4.2% at the moment. That said, though, it's possibly best to stay away from the stock for now, especially heading in the report, since it could offer more near-term weak guidance. If the consumers are trending in the wrong direction, we've already seen the earnings outlook for Q4 trend in the wrong direction. So maybe a line of support everyone who's listening could look for is near its 200-week, that really long-term moving average, which is down at around $88 per share. So way below its current levels, but if you're looking for a near-term opportunity to possibly start adding Target to your longer-term portfolio, worth considering that level. And overall, if we're looking at a 15-year time scale, it's about its most oversold it's been in terms of RSI level since 2009. So certainly worth considering putting Target on your watch list in the coming months if it gets to these really attractive entry points in terms of price and valuation. And the last stock we're going to look at is TJX Companies, which trades on the ticker TJX. It reports its Q3 FY 2024 results on November 15th. So JX shares, like Walmart, have soared to fresh highs over the last few months. And overall, it's an off-price apparel and home decor retailer that operates around 4,900, so nearly 5,000 stores across 9 countries, including the US, Canada, the UK, and Germany. Its brands include TJ Maxx, Marshalls, Home Goods, and Sierra. It's carved out a really nice niche within the rapidly evolving retail landscape, and it's actually thriving in a world that seemingly everyone thinks is dominated by Amazon by offering great deals on things that people really like to shop for in person. The company's cultivated a pretty loyal and growing customer base, and some of the appeal actually lies in the fact that you don't necessarily know what you're going to find at all of its stores, so it makes the shopping experience fun for lots of people and keeps them coming back, so the foot traffic's really high. And the company is always offering deals, which works at all times and especially works at times of economic uncertainty, which we're headed into now, and especially when people are being still hit by inflation. So TGX posted blowout second quarter results, and overall its comps were up about 6%, well above its own guidance, and were driven entirely by customer traffic. So that's a great sign. It wasn't just higher prices, that more shoppers were coming in. And overall, its comparable store sales at what it calls Marmax, so it's Marshall and TJ Maxx, which are kind of its core business, were up 8%, and that was entirely driven by store traffic as well. And it saw pretty strong sales in both apparel and home business. Overall, we're calling for about 7.5% revenue growth this year, and then another 5% revenue growth next year, and 19% growth on the bottom line, and then another 9% growth next year. So really stable growth. And this is on top of the company did about 3% revenue growth last year, and then it did 51% revenue growth the year before that, in that COVID boom, where everyone was just buying everything. So even though it's had that massive year-over-year spike for a company that's been in business for a really long time, it's still expected to do another 7.5-8% growth this year, and then 5% growth again next year. And then overall, its earnings estimate revisions activity is trending heavily in the right direction, and it boasts nice beats in the last couple quarters. So the stock is up about 4,800% over the last 15 years. This blows away the S&P 500. It crushes Target. It crushes Walmart. So you can see the stock has been on a really stellar run. More recently, over the last 3 years, the stock is up about 50%. This blows away the S&P 500, which is up about 22%, and Walmart, which is up 11%, and crushes Target, which actually now down about 34%. And then over the last 6 months, TJX is up about 16%. So really nice growth recently as well. And as I said, it hit new highs in early September/late August. It's now trading 50% below its highs in terms of forward earnings, which is pretty impressive despite trading right near its highs in terms of price. So it's trading at about 22.9 times forward 12-month earnings, which is, as I said, about 50% below its peaks and not too far above its 10-year median. Its dividend yields about 1.5% at the moment, and it currently lands as Zacks ranked number 3 hold. In 19 of the 16 brokerage recommendations that Zacks has are coming in at strong buys. So overall, Wall Street's really high in the stock, and it's still trading about 9% below its overall average Zacks price target. So TGX certainly worth considering, as well as Target and Walmart, as longer term kind of plays on the broader consumer landscape. It's not just for near term growth, but maybe you hold it for 5, 10, 15 years, some of these stocks. So don't necessarily try to play any of these stocks right around earnings, because earnings season's already been pretty wild with some big swings on both the up and downside after results. But certainly worth considering putting all 3 of these stocks on your watch list, with Target obviously being kind of the standout underperformer of these three names. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.